Well, good afternoon and welcome to our Valentine's Day edition of the I Want to Be a Trader series here at TradeStation. This series of TradeStation online webinars will introduce a wide variety of market analysis concepts and trading ideas for novice traders, highlighting the features of the TradeStation trading platform. Taught by both TradeStation and industry experts, these seminars start with the basics to demonstrate the practical application of market analysis tools for today's complex markets. Today, in our I Want to Be a Trader series, we're going to step up our knowledge and talk about trading credit spreads with Ms. Karen Smith, an instructor from OptionsANIMal. OptionsANIMal is an online trading firm, online trading education firm, whose classes are designed to improve the quality of the life of their students by helping them achieve the proper skills to protect your money, your well-being, their mastery of the trading strategies at hand, and successfully apply stock and option investment strategies that will make them better traders. That's why they're with us today. Karen is a wonderful presenter here for TradeStation. She's done a great job in the past, so we're very happy to have her back. Now, before we turn things over to Karen, I want to talk just briefly about our important information and disclosure that I need to run through to keep the lawyers happy. The following presentation is for educational purposes only. All the symbols and all the trading ideas that we discuss here are for demonstration purposes. They are not recommendations. Our presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Active trading is not suitable for everybody, and options trading sometimes carries a high degree of risk, and it may not be suitable for you or for other traders. So please read the disclosure information in the PDF handout that I've made available in the chat panel, and also you can find these documents on the TradeStation website. TradeStation offers a premium platform customization and setup service that will help you tailor your TradeStation platform to your own unique trading needs. A private 60-minute one-on-one session with a seasoned TradeStation platform expert might be all you need, and that would help you set up your platform with platform training, trading environment setup, and customization. So contact TradeStation and make your online reservation now to schedule your session. So today our presenter, Karen Smith of OptionsANIMal, is going to be talking to us about income trading using the Iron Condor. Karen, thanks so much, and I want to turn things over to Karen Smith right now. Welcome aboard.
Thank you so much, Don. It's a pleasure to be here with you and with all of you. Thank you so much, everybody, for taking time out of Valentine's Day, and happy Valentine's Day to you, by the way. So glad to have you here. Before I get started in teaching you about one of my absolute favorite, I call it a go-to trade that I use pretty consistently in this market environment, let me just ask a quick question there, if you don't mind typing in to your chat box, we might call it. Are you familiar with this trade? How many of you are currently using? Jim, thanks for the well wishes on Valentine's Day. How many of you are using this trade? Do I have any current traders using iron condors? Bruce, familiar, not using. Okay, well, we'll see if we can turn that around for you. Oh, quite a few of you use this trade. Have heard of it, not tried it yet, occasionally. Well, let me say this. For those of you who have never seen or used an iron condor, at the end of our hour or so together today, I'm going to give you the basics about what is this trade and why might we consider using this trade. Pedro, nice to see you again. Yes, we did meet one another the other day in Ventura. Welcome. Glad to have you here at one of our OptionsANIMal events, right? That was a wonderful Saturday event. For those of you who have experience, maybe you've done this a dozen times, maybe you've done it 100 times or more. I'm going to take you what I like to call further down the rabbit hole and give you some considerations, some things to think about that perhaps you haven't before when it comes to this particular trade. All of this, of course, is intended for educational purposes only, and it is in no way intended to be a recommendation or any sort of investment advice, obviously. Okay, I want to show you who we are at Options Animal and how we teach individuals trades like this one, the iron condor, so that you can be profitable in all market situations and environments. So as I said, we're going to talk about an iron condor, how it is that we begin to structure or put one of these trades together. And then, as I mentioned already, we will talk about some different styles when it comes to iron condors. At the end of this time, I do have a very special offer for you regarding becoming a student with us, a member of our fantastic Options Animal community. In essence, what we are doing with an iron condor is putting together two individual spread trades. We teach over 20 different spread trades at Options Animal for different market environments. Two of those trades are what we call the bull put and the bear call. Those of you with experience, you probably know this as selling a call vertical and selling a put vertical. And the numbers that you see notated here are simply the class numbers that we have inside our curriculum. So we put these two trades together. And when we do that, we create a credit trade with an expectation for a range bound scenario. There are many times when the market as a whole, perhaps not at this moment in time, but the market as a whole or individual equities that we like to use in our trading become range bound. Okay, they're in essence consolidating a move perhaps that they have had over the course of time. And so what we're doing with this trade is creating a structure to take advantage of a range when we don't expect an equity to be particularly bullish nor particularly bearish. The structure of this trade is to sell or short a put at a higher strike price than a long put or a put that we purchase. That is what combines the bull put trade. Then on the other side of the option chain, we're going to combine a short call and a long call, with the short call being at a lower strike price than that long call to create the credit trade, the bear call trade. Now, the thing that I want you to see here, okay, if you're looking at this on the option chain, is right there. Notice how there is this difference between our two strike prices, our short strike prices, our short put strike at 182, our short call strike at 187. In essence, what we are doing is we are saying, hey, equity, as long as you remain anywhere in this range, I'm going to get to keep this credit that I take in. I like to say we get paid on day one with this trade. And the idea is we want to keep this credit that we generate on the very first day. The thing I love about these trades is that we do not have to be so specific on where exactly an equity may go for us to be profitable. Now, some of you may be really good forecasters. You might have your set of market indicators, equity indicators, technical indicators, right? We look at those charts, we take a look at what's happening in the broader market, and you may be really good at pinpointing where an equity is likely to travel to at a particular point in time. Now, what I have found over my many years, first being self-taught in 2008, the Great Bear Market, joining Options Animal as a student in 2009, graduating, and then now having the privilege of being an instructor for almost 6 years with Options Animal, what I found is that it's pretty tough to consistently pinpoint exactly where it is that an equity may go for a particular period of time. Now, it's not quite so difficult to forecast a range of outcomes, a range of possibilities as to where an equity may go. And as such, this is a trade that can give us higher probabilities of a successful outcome, a profitable outcome, as compared to some other trades that we can use at various points in time in the marketplace. So as I mentioned, we have different short option strikes. We put together these two credits, and that's our reward. This is what that profit and loss graph looks like. We like to call this the pilgrim hat because it sort of looks like that, doesn't it? What you see here is the range across the top that I just showed you on that option chain. As long as the equity remains in this area, all of our options are going to expire worthless. At expiration, we get to keep the credit that we generated. Now, the other thing to note here is that we have what are called, break-even points on this trade, meaning that an equity can go a little bit beyond one of our strike prices. It can go a little bit higher than our short call strike price or a little bit lower than our short put strike price, and yet we can still have some degree of profitability in this trade. Now, as I mentioned, the maximum that we can make right here across the top is going to be the credit on both sides of the trade, the bull put side and the bear call side. The risk that we entertain in this trade is the side with greater risk, if they are not the same, minus the net credit. Now, what do we mean by side with the greater risk? You notice in this particular example that each side of this trade is a mirror image. If this were on a piece of paper, we folded it in half, you would have mirror images from side to side. What that means is that each side of the trade, both the bull put side here and the bear call side here, have the same size spread. Maybe it's a $5 wide spread, maybe it's a $2.50 wide spread, it could be a $10 wide spread, but they're the same on both sides. We can actually, I'm going to say lean, if you will, into one side of this trade or the other. And if we were to do so, we can have a wider spread on one side than another. When we do this, our brokers, the margin that is required on credit trades is going to be based on the side that has that wider spread. I will tell you, I'm going to say 98% of the time when I do these trades, I use the same size spread on both sides because it's the most efficient use of our capital and our margin that we have. Now, that doesn't mean that there are not times when I will have differences between the two sides, but most of the time I keep it the same. Break-even points, as identified right here, our upper, or you could think of this as the bullish break-even, will be our short call strike plus this credit that we take in. So in other words, once we give back the credit that we started with on the trade, we begin to experience loss, which is of course limited here through our long call. Our lower, you could call this bearish break even, is going to be our short put strike minus the credit we take in. And once again, once we give back that credit, if it continues to be bearish, we will begin to experience loss. And of course, our loss is capped because of the long put that is part of that bull put spread. Okay? If the stock is between these break-even points, we will have some degree of profitability with maximum profit achieved if we're between our two short option strikes. So what I want to do now is take a few moments because some of you may be newer to credit spreads, and I want to show you how it is that we begin to teach this information. You know, as a student of, graduate of, an instructor now of this curriculum, I know that here at OptionsANIMal, we do it better. We teach in a more thorough manner than others do. This is not a new trade. In other words, you can learn about these trades from others. But what you really want to know is not just what is this structure, but why would you use it? How would you use it? And furthermore, are there things that you can do if the trade does not go the way you expected it to? So if we were to go back to that prior slide, let's just do this really quickly. Let's say that our equity is in fact so bullish that it goes through our break even, or so bearish that it goes through the downward or lower break even. Are there adjustments that we can make to bring this broken, what could be a broken trade or a losing trade, back around to a profitable conclusion? Absolutely, there are. As a matter of fact, we teach over 6 potential secondary exits for this trade. Now, today we're not going to focus on that so much, but I want you to know that that is a very key and important component inside our curriculum. So let's sort of reevaluate here what these two trades are, the bull put and the bear call. Starting with the bull put, we sell a put. And this short put gives us the potential obligation to purchase shares of this underlying equity for the dollar value of the strike of this put. We use this because we expect for an equity to be bullish or stagnant. We keep the credit we generate when the equity is bullish or stagnant, and that is the profit that we have in this short put. We sell this at the bid price. Now to this, we're going to add a risk limiting instrument. Some of you who have experience with trading may sell naked puts. And while that's a topic of discussion as to whether that's prudent or not for a different day, what we want to do here is we want to limit risk. And again, most effectively use the what we have in our portfolio. Each one of us has a different size portfolio. We want to effectively manage our funds. And one of the ways that we can do that is by spending what I like to call pennies on the dollar to limit risk that we have in these trades. That's really what spread trading is all about. So we are going to add a long put, and its function here in this trade is to limit risk because it gives us the right to sell shares of this equity for the dollar value of the strike of this put. Now, when we use it individually, by itself, if you will, a long put optimizes, makes money for us in a bearish trend. But in this particular trade, it is going to function to limit potential loss that we could have if an equity is bearish and does, in fact, start to fall beneath our short put strike. The reward that we get in this spread trade is the credit that we generate, and the risk that we have is the spread, the difference in strikes minus that credit. Okay, so that is the put side of our iron condor trade. And as I mentioned to that, we're going to take in a second credit, go to the other side of the chain now, and utilize a bear call. Okay, this is you might notice from the names that we give trades. Obviously, these are vertical trades. Like I said, this is called selling a put vertical, selling a call vertical. We do this so that our students can actually, from the title, see the instruments that we're using and the sort of trend that we're working with. Okay, just kind of identifies that, makes that a little bit simpler from the start. With a bear call, we are optimizing, looking for a stagnant to bearish trend utilizing this trade. We start with the short call. This short call, the call that we sell, gives us the obligation to sell shares of the underlying equity for the dollar value of the strike of this call and works, makes money for us in the stagnant to bearish trend. To that, we add a long call. Can anybody tell me a short call by itself, if you just shorted a call, what is the risk in a naked short call? Can any of you tell me that? If you just short a call alone, an individual trade, what is the risk? Oh, yeah, unlimited. Right. And I love Jay puts it in all caps unlimited. That's right. Okay. So your brokers will not even allow you to do this in your IRA accounts because they consider this so dangerous. You know, unlimited, another word for that, unquantifiable. There's no ceiling, right? There's no cap on how high an equity can go. Just take a look at Tesla, right? As an example in the marketplace today, when it comes to not having ceilings and an equity goes up day after day after day, and you're 100% exposed to that. Now, we do want to utilize these short calls. It's just that, once again, we're going to mitigate risk, effectively use our capital by, for pennies on the dollar, adding a long call. And the function of this long call in this trade, by giving us the right to purchase shares of the equity at the strike of this option, limits our risk that we entertain with our obligation to sell. Okay, so we put these two pieces together. Short call is the primary instrument. Primary instrument means driver or money maker, if you will, of the trade. The long call limits our potential loss. Once again, the reward here is the credit that we generate, and the risk is the spread or the difference in strike prices minus that credit. Okay. Here at OptionsANIMal, we teach what I like to call a lather, rinse, repeat process. Everything that we teach in our 8 levels of curriculum boils down to just 6 things that we do, 6 steps that we take on every single trade that we place. And this is exactly what we teach our students to do. Okay. Now, the results of this process over the past 7.5 years, we are closing 90, that is 90% of our trades with a profit. 90%. Okay. This is one of the missing pieces for myself. In the Great Bear Market of 2008, where being self-taught with options, I lost money, like many. How many of you lost money in 2008, by the way? I'm just curious. Not to bring up bad memories, but I lost money. being self-taught. It was a very, very painful lesson for me. Okay. Jim, how many of those are open positions or iron condors? It varies because we use all of the 20 plus trades that we teach as illustrative tools. These are real trades. This service is called our Animal Trade Plus service. And the actual purpose of it is so students can watch their instructors, I being one of them, trade in the markets. That's what the purpose of the service is. And that students are able to write in with questions and all of these sorts of things. Now, at times, Jim, I've done open condors, iron condors, let's try that again, multiple times for my trades. There are a lot of credit trades that are actually part of that particular service, and then there are other trades as well. Again, we try to illustrate everything that it is that we do through these trades. That's a really good question. The reason that I bring this up is because right here where it says primary exit, okay? Um, and I agree. Jay is saying 10% losers can wipe out 90% winners. Well, actually, I have a slide. You stay tuned, Jay, because it's an excellent, but particularly on credit trades, right? I don't have this slide today, but I have a slide that shows the difference between a 79% and even a 90% track record on credit trades. And you're absolutely right from the standpoint of you on particularly credit trades because our risk is greater than our reward in these trades most of the time, depending upon how we position it. And so as such, you're right, you can wipe out way too many profits with just a few losing trades. Now that's not the result that we have at Options Animal. Okay. You stay tuned because again, we teach adjustments. We teach you how to fix the losers so that they don't wipe out those winners. And I will share those statistics with you in just a little while. So it's a very good point. Back to the sixth step, lather, rinse, repeat process. Step 4 of this process is to identify the planning, the map, I like to call it, for the trade. This involves the determination up front of two things. What we call the primary exit, meaning everything goes according to plan, and we're profitable. Well, here we're looking for the equity to stay within our short option strikes. We could take it all the way to expiration, allowing all the options to expire worthless. This happens to be my personal favorite. I did some of this today, as a matter of fact, on some iron condor trades that I have. Close at a percent return on risk, particularly if you can close it a few days before expiration. This is the sort of trade that can work beautifully, perfectly for several weeks. Let's say you're doing this in a 30-day window, for example. It works beautifully for several weeks. And then 2, 3, 4 days before option expiration, okay, something happens. Black swan in quotations, something you're not expecting. And all of the weeks of theta decay, which is what we're working with on this trade, extrinsic value decay, are gone because the equity makes such a strong move right at the end. And that is why this is my absolute bar none favorite way to manage these trades. I love to close them early, particularly if I can get 75% of the credit in half the time. And that does happen, my friends, when your equity is very, very range bound. Take a look on your own time at Alibaba, for example, ticker symbol BABA, B-A-B-A. I did an iron condor on them a few weeks ago. That trade is already closed out now, but you'll see how stagnant it went after earnings. For example, I did the trade for that reason. It made its big move on earnings, and then I went in afterwards with the thesis that it was going to consolidate that move, and that's exactly what happened. And there are many equities that will repeat these kinds of patterns, and it can provide great opportune moments for this particular trade. Now let's get into the idea of secondary exits. We're too bullish. We're too bearish. We're going through one of our short option strikes. Okay. We can close this at a theoretical break even or at a percent net loss. But as Jay very clearly and was correct in identifying, too many losers here wipe out too many winners. So what we really want to do is we want to adjust. We want to bring this back around. In a very bearish trend, okay, this is where you have an expectation that not only is the equity gone through your short put strike, but is likely to continue to be bearish for a period of time, we can add a long put option to the trade, creating a version of what we call a put ratio back spread, a trade that we teach here at Options Animal. We can take possession of a stock and collar trade it. This collar trade is what I like to call the great game changing trade. It is the trade that brought me in personally as a student here to Options Animal. And this involves, through obligation with the short put, taking shares. Remember how I said that we're obligated to take shares at the strike of the put that we have sold. So I call it the natural secondary exit, where we accept the shares. This credit that we take in on this iron condor, if in fact we take shares, you get to keep this credit that you generated. It reduces your beginning cost basis in your shares. Then you can move on with this share-based trade where we use options around those shares, both to mitigate the risk that we have in the shares as well as to get even higher returns on those shares while using options. Okay. Uh, Oftentimes, when I want to own an equity, I can always go pay the market price on any given day. Or what I can do is I can set up a trade like this. Maybe I just do the bull put side of the trade if the equity's quite bullish. Um, Perhaps I do an iron condor to begin with this secondary exit. And what I do is I take the shares at a 2%, maybe 3%, maybe 5% discount from where the shares are trading, the value at which the shares are trading when I start this trade. I'm a discount shopper in everything, and I apply that same mentality to the marketplace, particularly because I know that once I have these shares, I know how to collar trade for exceptional returns, double digit returns easily on a yearly basis. So it's a fantastic secondary exit for this particular trade. We can also roll the trade out of the money and further out in time. How many of you are familiar with the concept of rolling trades? I'm sure quite a few of you credit traders are familiar with the idea of rolling trades. Okay. Basically, what we're doing is we're staying in this same structure, okay, our iron condor. We're just repositioning it further out in time. We're sort of, what I like to think of is we're getting out of the way of the shorter term price action that is occurring in the marketplace. You know, the equity just went up a little too high, went through our short call strike, went a little too low, went through our short put strike. And so basically what we're doing is saying, I still expect a range. It's just that I need to adjust this range because I've had a little bit more, I like to call it zigzaggedness, right? The day to day up and down that equities have, I had a little bit more of that than what I anticipated when I started this trade. This can be a very effective, by the way, secondary exit for this trade. Okay? The only thing that we sacrifice here is time. It takes us a little bit longer to be in the trade for the profitable conclusion. Now, in the very bullish trend, so this is the idea where the equity is rising higher than what we expected when we started the trade. It's going through our short call strike. We can add long calls. Okay. We can roll the trade out of the money and further out in time. We can even go in and buy shares. Now, I just mentioned to you that I like to use the put side as a way to acquire shares at a discount. There's nothing wrong with going in and purchasing shares of an equity when the equity is having strong momentum to the upside, right? Case in point, I'm going to go back to it again, but Tesla, I happened to pick Tesla as an equity to watch this year for 2017. And there have been many points in time when you would have said, wow, do I really want to buy Tesla right now? I mean, it's at another all-time high. Oh, it's at another. Oh, wow, it's at another all-time high. These are momentum equities. And so purchasing an equity when it has that kind of momentum is not necessarily a bad thing to do either. So here in the bullish trend, we can also purchase shares and reposition our short call, particularly our short call that's part of our bear call, further out in time and out of the money. So there are things that we can do, adjustments we can make. I've had to adjust a couple of trades so far here. What are we? I think we're in week 7, maybe something like that. I've done, I think, 8 or 9 iron condors so far this year. Um, One of those I had to reposition, and it was exactly the scenario I described to you where the equity, I had been in the trade for several weeks, trade's working beautifully. The last week, Okay, I was hanging in there for a little bit more, theta decay into the last week on the trade. And the last week, this particular company had a negative announcement and the shares fell double digits right through my short put strike. With a few days to go. And I giggle because, I mean, this happens. We've all had things like this happen. I know if you've been trading for a while, you have stories. We all have those stories, right? I was able to adjust it. I didn't panic, nothing like that. I just adjusted the trade, have brought it back around to the profitable conclusion in less than a month's time. So I just share this with you because I am a product of the very education that I am showing you today. And it works. I know it works because I use it each and every day. All right. So let's talk about a good chart, a good setup, if you will, for an iron condor. And the thing that you see here is a range. We could draw a couple of different ranges, couldn't we? We've got kind of some intermediate support here around 63. We definitely have resistance that's pretty easy to identify here at 66. And then we have another, a second, if you will, level of support here for the bottom of the range at 61 as well. So what we're going to do is we're going to establish an iron condor with an expectation that the equity, this is an equity that likes to range. Okay, this is kind of a probably something like maybe a Coca-Cola. Whole Foods at different times likes to range like this. Starbucks is ranging like this right now. Certain equities just go into these patterns where they will be in a range for a period of time. So we want to take advantage of that. We want to position our bear call here above resistance, meaning that we want to sell a call, the short call on that bear call trade, to be above this resistance point. And then we want to establish the short put, the bull put side of the trade, below this support. So you notice here we've got resistance at 66 and support somewhere in the 62 neighborhood. So here's the structure of the trade. Okay, putting this together. So for the bull put side, the put vertical side, we sell to open a strike 62.50 short put, 34 cents of credit here. Then we buy to open a strike 60 long put at a 15-cent debit for a total credit on the bull put side of 19 cents. The risk that we have in this bull put is our spread, $2.50, minus our credit of 19 cents, or $2.31. Worst case scenario, okay? This equity SEC investigation. That always comes to mind when I try to think of a reason as to why we have a black swan event, particularly to the downside. The market generally doesn't like those SEC investigations, right? And so you get this really big 15-20% strong move to the downside. Or if you happen to be Under Armour in the last earnings season, a kitchen sink quarter, we like to call that one, right? Where you just kind of throw it all out there and you say, well, you know what? This was just one of those. Let's get it out of the way and move forward. And your equity falls to those levels. If something like that were to happen, you were not able to adjust this trade, $2.31 per share is your maximum loss. Okay. Now let's go to the bear call side of this trade. Sell to open, the strike 67.50 short call, 26 cents of credit. Buy to open, the strike 70 long call for the 4-cent debit, 22 cents of credit here on our bear call side. The risk in the bear call, same size spread, the $2.50 wide spread minus our 22 cents of credit, $2.28. So we put our two credits together, our 19 cents on the bull put, 22 cents on the bear call, and that gives us a total credit of 41 cents. Now I'm going to ask a question because many of you said you do know this trade, you're familiar with this trade. Can you tell me what my risk in this trade is? What is my risk, dollar and cent risk in this trade? For those of you that have familiarity, what is my risk in the trade? Oh, nicely done. Beautiful job. Okay. I do have experienced traders here. I love this. And you are correct. $2.09. And I asked that for a reason, right? Paul, Mohan, Jeremy, nicely done. It is not, we do not add together the bull put risk and the bear call risk. Because if we were to add these two risk factors together, it looks like it's $5 of risk, right? Instead, we take one side. Remember, I said only one side of this trade can break at expiration because in 32 days, that's the lifetime of this trade. In 32 days, This equity, we'll call it XYZ, okay? XYZ is going to finish at a particular dollar value, and it can only finish at one particular dollar value. When it does, you cannot have a broken trade, a losing bull put and bear call at the same time. It either finishes below the 62.50, in which case it would be the bull put side that could experience loss, but the bear call side would have full profitability on its side. Or vice versa. It finishes above 67.50, in which case our bull put worked perfectly, but now it's our bear call that's being challenged, right? So the risk is the $2.50 wide spread minus our 41 cents of credit, or $2.09. And again, kudos to those of you who got that one right. Return on risk here, 41 cents divided by the $2.09 risk, that's a 19.6% return in just 32 days time. This is what I love about these trades, okay, is that you can get double digits, sometimes even above 20%, depending upon the time frame and the equity that you're using, in a relatively short amount of time. Fantastic. When you annualize this, my friends, it's hundreds of percent per year on these trades. Richard's got a good question. Do I look at the short option delta and the risk reward in terms of selection criteria and choosing the options for the trade? I love that question, Richard. Thank you for asking that. When I was a new trader, okay, even a new graduate at OptionsANIMal, I knew when I first saw these trades, these trades, by the way, as I mentioned, taught in level 3 of our 8-level curriculum. So I joined as a student after that great bear market in April of 2009. And so as I was going through the curriculum, I got to level 3. It was probably about May to June when I got to this. Okay. And I remember the first time I saw these trades, I was hooked instantly. I said, I know that these trades are going to be sort of go-tos for me. And the reason for that is because, as I mentioned earlier, we don't have to be so perfect in terms of pinpointing exactly where an equity is going to go. It's a little more forgiving, if you will, right? So I knew that I would be using these trades. Well, one big mistake I made, Richard, that has to do with what you're asking, is I would start on the option chain. And so I'd go to the option chain and I'd take a look and I'd want to get at least this 20% return in my 30-day window, and I'd start putting the pieces together there. And then when I had it all put together and it looked really nice, then I would go back and I would look at my equity, which could have been a Starbucks or a Nike or an Apple, all equities I've traded for many years. And I'd go back and I'd look at the chart. And then I'd kind of like turn my head to the side and close my left eye, and surely I can make that fit, is what I would do. In other words, instead of really looking at what's going on with my equity, what's its trend, how strong is that trend, right? Confirmational bias. Yeah, exactly. I went the wrong way. So what I do now, all these years later, Richard, is first of all, I have a set of equities that's consistent, that I have traded for many years. And when you do that, what you find is you start to see patterns with them that are kind of almost second nature. I hate to call it that, but it really is true. I've been doing this for so long now. I see it. I see patterns in Apple, where I go, oh, I've seen Apple do this before, and I know what it did last time it made this pattern. Doesn't mean it does it again, right? That's the truth of the market. But oftentimes history it will rhyme. It may not repeat, but it can rhyme. And so you spot those kinds of opportunities in your charts. So I base it more there than I do an absolute delta. I know that there are some trading services out there, and some of you may have at some point subscribed to these that say, "Oh, look for about a negative or positive 0.20 delta." Right? Has anybody heard of services like this? They'll give you a certain delta to look for, right? Because delta is loosely thought of as the probability that an option finishes in the money. And so if you've only got 20% probability or something of that sort, it's low probability. But the problem with that is that that probability is derived from what's been happening, how the equity has been moving, what's been happening in its chart, and it doesn't forecast unusual things that may come to play. For example, those probabilities don't take into account earnings and how rapidly and quickly equities can move at earnings. So there's some real limitations, I believe, to just going in and looking for a particular number. It's more about knowing trends, knowing your equities, and spotting opportunities. So thanks for the question. It gave me an opportunity to kind of discuss that. And I hope that makes sense. Okay, break even points on this trade. Upside, bullish, break even. The short call strike plus the net credit, which in this case is $67.91. So in other words, the 67.50 strike plus our 41 cents of credit. Downside, bearish, break even we could call it. Once again, the short put strike minus the net credit, which in this case is 62.09. So as long as our equity remains inside this range for the next 32 days, we're going to have some degree of profitability. Another great question, Jim, and that is, do you avoid earnings when selecting a duration? Yes, sir. Now, there's a great conundrum there. And those of you who've done these trades know what it is, right? What happens to the credits that we can get on this trade or on either side of this trade, right? Credit trades in general. What happens to those credits before earnings? When we go to that option chain and we take a look at the credits, are credits bigger or smaller ahead of earnings? Typically speaking, credits bigger, credits smaller. Yeah, Pedro, increased dramatically, much bigger. Big balloon is what I like to call it. Now, I'm a credit trader. I want a big balloon, right? I want more credit for the risk that I'm taking. The more credit, the better. But here's the conundrum. There's a reason as to why that credit is so big. As Pedro is saying, and it's correct, implied volatility's up because you could be Under Armour and move 16, 17, 18% in a day. You could be Qualcomm and move 10, 11, 12% in a day. In a day, right? That's why the premium is so big. And remember, we're working with a trade here that's range bound. Too much trend is a problem. So one of the favorite things I like to do, one of the things we discussed, Pedro, right, on Saturday in Ventura at our live event, I like to go in after earnings, particularly the day after earnings, because implied volatility, that balloon of premium, starts to crush immediately once the earnings event is known. Once the big move is or is not made in the marketplace, your implied volatility starts to contract. Think of a balloon that's deflating, okay? And it happens relatively quickly, but not immediately. So if I have history with a particular equity, and let's say that it makes a really big move one direction or the other, particularly a bullish move, okay? It can work on the bearish side too, but I have found more success on the bullish side. So it makes this really big gap up, right? And maybe it even goes beyond its upper Bollinger Band. That's a technical indicator we work with. We teach here at OptionsANIMal how to utilize that. So it gets a little extended is what that means in the short term. That can often be, not always because there is not an always, but it can often be a good time after earnings to go in and structure a trade like this where I still have at least somewhat elevated premium. I did this successfully. Remember how I said I've done several iron condors this year already, right, that have closed out? That's what I did on Alibaba. That's what I did on Netflix, uh, JP Morgan. Who were the others? I'm trying to think. Lululemon has given me good credits this year on iron condors. So there are instances where you can find and spot those opportunities to do that. Okay? Good questions and comments, by the way. Really appreciate that. How many of you feel that you are comfortable with the Greeks in your trading? Delta, theta, vega, gamma, and rho. 5 Greeks, 5 inputs to premium, 5 factors, if you will, that explain to us premium. The second level of our curriculum here at OptionsANIMal, I call it the most important level, the go-to level, because it is where we get into the ins, the outs, the specifics of options. Options are derivatives. They derive, they get their value from another instrument. So the options on Apple those options get their value from the shares of Apple, right? And so on and so forth. Okay. The way that premium grows and gets bigger, the way that premium shrinks and gets smaller is can be profit to us in either direction, first of all, depending upon the type of trade that we're doing. And to see how that premium will grow or will shrink is identified by the Greeks, which is why in the second level of our curriculum, we teach the Greeks. Now, we also, as you can see right here, these are slides from our curriculum that you're seeing today. As you can see right here, we're going to go in on every one of those 20 plus trades that we teach here and teach you the Greeks for the trade. You do not have to write a dissertation, okay? Although we do have a few instructors on our staff who could do that. I'm not one of them, uh, who could actually probably do that. But what you want to do is have a very thorough working knowledge. Because how can you know? How can you spot opportunities in the marketplace? How can you know the different types of trades that you might want to place if you don't understand premium and you don't understand what's going to make premium go up or make premium go down? You can't read where the opportune moment may be in the marketplace or on your individual equities. This is where the Greeks are so very helpful. Okay, and so what I'm going to do now is to show you the Greeks for an iron condor. Generally speaking, are there different ways that we can place iron condors? Yes, there are. Will their Greeks look different than what you see here? Of course, they will. But this will give you at least a good beginning sense, okay, of how these various factors are going to come to play on this trade across time. It's helpful in determining which trade to place, how to place the trade, how to manage the trade, which may, of course, include adjustments, and also when to close trades. It's helpful in all of those 6 steps that I mentioned earlier in our process. The Greeks help us in each and every one. Beautiful chart. This is what we're looking for, right? Range bound scenario. Again, this is an equity that will range for a while and then it will get a strong move. And then it will come back and it will range for a while and move. And then it comes and then it ranges again. So we're working with these periods of range bound activity for this trade. So our equity is trading at $68.90. So we're going to establish our iron condor selling the strike 67.50 short put, selling the strike 70 short call. Okay, so there's kind of the range that we're working with here. Buy to open the strike 65 long put and the strike 72.50 long call are risk limiting instruments here. Total credit of 72 cents. So we have a $2.50 wide spread, right, on either side. So we take that and subtract our 72 cents of credit. $1.78 is our risk. We're looking for a 40, that's 40% return on risk. Our equity just needs to remain within this range for the next 31 days. So again, this would be outside of an earnings window. And it is important for all of the trades that we teach. It's important that you keep track of earnings when earnings are forthcoming, okay? Because we will teach you trades inside our curriculum that are great for earnings. It's exactly when you want to do them because you want to take advantage of those strong moves that equities may have. And then we teach you some like this that you don't want to place at that time, but rather at other times in the market. Okay? So let's take a look at the Greeks for this trade. So I'm just going to go ahead and populate this, and then I'm going to take us piece by piece through these Greeks. And again, this is what we teach for all of the trades that we teach. Okay? So our primary instruments, money makers, are our short options, our sold options. When we sell options, we reverse the signs of the Greeks. Every time you open your option chain, okay, what you see there is presented from the standpoint of purchasing, going long the option. So anytime you sell an option as part of a trade, you need to reverse the signs of the Greeks. And again, the Greeks helping us to say, how's premium going to grow? How is premium going to shrink? That's what the Greeks are all about. Okay. And so we reverse the signs on our 2 short options. Our 2 long options are risk limiting instruments. The Greeks are as they're presented. Okay. And so then we literally sum it up. Use a calculator, sum it up. We can put a dollar sign right here in front of all of these Greeks. Okay, because that's what you're looking at when you're looking at what we call net position Greeks. How is this trade going to make me money? How does this trade have the potential of losing me money? Okay, that's what the Greeks are about. We're going to start right here at the top with delta. Remember I said I'd take you down the rabbit hole. That's exactly what we're doing here, right? Delta. Notice it is a negative $5.62. Okay. With an iron condor, you're generally going to have a little bit of a positive or a little bit of a negative. But the key is little bit. Okay. If I have an at the money call on an equity, right? And at the money call means that the strike of the call is the same as where the equity's trading. Apple's at 135, a strike 135 call, right? That call will have a delta of a positive $50. Okay. If I have an at the money put, it will have a delta of a negative, roughly, not exact, $50. I have a negative $5. So I'm giving you a point of reference, a frame of reference here. Okay. This is not a big delta. That should make sense because remember I said this is a trade for range bound activity. We don't want to have a big delta to start this trade. Now, one of the things that does come to play in the trade, a big input, gamma. Gamma is the accelerator, the gas pedal, you could call it, okay, for delta. And you might notice that this is actually the biggest Greek, the biggest number of all the Greeks, right? Almost twice as big as the next largest, which is Vega. So what does this big negative gamma mean? Well, it means that if our equity starts to trend, so it starts to get a bullish trend, starts to get a bearish trend, it really starts to move, it's going to start to give us a delta. And the delta that we will get on the trade will be the opposite of the direction that the equity is trading. So in other words, let's say our equity starts to be really bullish, okay? And it starts to go through or approach or go through our short 70 strike in this example. What's going to happen here with this delta is it's going to become a bigger negative delta. Now, a negative delta is for a bearish trend or a stagnant trend. So it's going to work in the inverse and it's going to create the potential ultimately of loss in this trade. Okay. So the big gamma means if you start to get a trend, it's a problem for this trade. We want no trend. This is where we actually want for an equity to just sit around and sit around. Okay. How do we make money? Well, right here. This is really what we're taking. Actually, there's two Greeks that we can take advantage of really in this trade. And that's going to be theta and vega. Theta, options lose money every single day. This is one of the reasons why I'm drawn as someone who understands options premium. I'm drawn to credit trades because options are wasting assets. Each and every day that passes, an option is losing money. I want to take advantage of that. How do I make money on the fact that options are decaying assets? Well, it's right here, theta-based trades, credit trades. I'm selling a wasting asset to somebody else. And every day that goes by, tick tock of the clock, and the equity is not going to or moving through my short strikes, options are decaying. That is profit to me. Okay. So that's one of the Greeks absolutely that we're working with here. The other is this bad boy, Vega. Okay. Vega is the Greek for implied volatility. Implied volatility is such an important concept when it comes to options that we have a class dedicated just to implied volatility. here at Options Animal. Because implied volatility is all about that ballooning. We talked about the ballooning of premium before earnings and the shrinkage of premium after earnings, right? Implied volatility is about that. It is about what makes premium balloon up and what makes premium shrink. Right now, for those of you who are credit traders, right, are you frustrated in the marketplace right now as I am, trying to find opportunities for these sorts of trades? If you are, why are you frustrated in the market right now? What's going on in the market right now that's making a trade like this a little bit more challenging, generally speaking? Obviously, it's always equity specific. But what's happening in the marketplace right now? Richard, we've got a VIX very low. John, volatility very low. Yes, incredibly so. As a matter of fact, with today's positive action, the VIX even dropped below that 11 again, right? What that means, for those who haven't studied this yet, what that means is that balloon of premium is very low, generally speaking, on options right now. It's actually a good time for other trades that we teach where the purchased or long option is the money maker in the trade right now. Now that doesn't mean I'm not doing credit trades, by the way, okay? Because you find individual opportunities inside your watch list. But generally speaking, because balloons are small, you don't get paid as well for the risk that you are taking in the market. Now, what's really interesting is what happens. Margaret says we have sideways action. Absolutely, Margaret. What's interesting is what happens when the markets get nervous, right? Or we start to have bearishness come to play. That's where things get really interesting because that's where that balloon of premium goes up. It can often be a fantastic time to go into trades where you sell premium because what this negative Vegas says is if I go into this trade today and then after that implied volatility goes up, it hurts my trade. It's going to take me that much longer to be profitable in this trade. If implied volatility goes down after I place this trade, it's helpful to me. It's potential profit to me. Maybe I can even be in the trade for a shorter duration. So I look for those kinds of opportunities on a daily basis where something's happening with an equity that's providing those opportunities. And again, that's all part of what we teach in terms of looking for the opportune moment. So much of what we teach is about looking for the opportune moment with these various trades. So as I mentioned, the iron condor is a trade that optimizes the stagnant range-bound trend combining bull puts and bear calls. The short put and short call, they're the money makers in the trade. The long put and long call limit risk in the trade. The maximum reward is the net credit of the two trades, while the risk is the difference between the strikes of the wider spread if they are not the same, minus the credit we take in. And as we've already said, earnings is not the best time to do this. Now, normally I would stop here, but I'm going to take you a few minutes past the half hour, if that's okay. If you'll hang with me and you'll wait for that special offer, if you promise you'll do that, I'm going to take you a little further down the rabbit hole, okay? 2015 was a very flat year on the market, wasn't it? Okay. It was a really good year for iron condors. And there is a particular style of iron condors that I like to do. I'll be honest with you, I'm not doing a lot of them at this moment in time because of what's happened with implied volatility in the market. There are better opportunities for my capital right now than what I'm about to show you. But you go back to 2015 when the market itself is sort of flat. Implied volatility was low, but not as low as where we are today in the marketplace. And using this other version of the iron condor on the S&P, actually I used the SPY, the ETF, exchange traded fund for the S&P 500. I had double-digit returns in my portfolio on just that one trade that year. Okay. So very quickly, I just want to take you a little bit further for those of you who have experience and also show you what it is we really do here at Options Animal. When I talk about how you can take a trade like an iron condor that we often think of being short term, right? 30 days or less, take advantage of excessive theta decay. Well, what if instead of doing that, by the way, that's this guy here. he's the short-term iron condor, and particularly when it comes to options expiration, right? This is where he sits because at options expiration, all the risk capital is gone. That's what we profit from if the equity remains within our range, right? But let's say we go 2 months, 3, 4, 5 months out in time. Okay, and we have all these nice, happy polar bears. The interesting thing is that these polar bears have lots of ice. They have lots of room to roam or change their position, right? They can move forward, they can move backward, as compared to when we get close to expiration. Well, option premium is a little bit like this. When we go further out in time, what we find is, let's say for a minute that my equity is is its value is right here. It's sort of in the center of these polar bears. Okay, this is where my equity sits right now. So if I go further out in time, let's say 4 months, for example, okay, I can find strike prices. I can find puts that are maybe 10, 12, 15% out of the money. I can find calls that might be 8, 10, 12%. Again, depends on the market, depends on the equity, out of the money that actually have some premium to them. And the advantage of working out here on the horizon, so to speak, okay, is that especially if we're working with the SPY or the S&P or the broader indices, how many times does the S&P gap up or down 5% in a day? Not very often, right? I mean, it can happen, obviously. We were going to be limit down after the election. We never got there. It was in the after hours market. We were going to be limit down on the S&P 500, for example. But those things don't happen very often, do they? So what this means is if I can create wide iron condors way out here on something like the SPY, where it's not going to immediately gap to one of my strike prices, which individual equities can do, okay, with those black swan sort of events. Well, what might I be able to create out here in time? And what would be the advantage of doing so? Well, here's the thing. Theta expresses the loss of extrinsic value, and we know that it's only that risk capital value that decays. But the interesting thing is that options that are much further away from where the equity is trading, they're the ones, and I'm going to go through this sort of quickly. Understand, inside the curriculum, we spend lots more time on the understanding of this concept. But in essence, options that are way out here, these are the ones that are, 10, 15% away from where the equity is trading. They actually decay much more quickly as far as the pace of theta decay goes. They decay much more quickly, much faster than options that are much closer to where the equity is trading. So it kind of goes, I like to say it goes from the outside in, which means that if we're playing out here, if we're working out here with options, and these guys that are 10, 12, 15% away from where the equity is trading, they're losing premium very, very, very quickly out here. Well, wow, that gives me the possibility to stay way away from where my equity is trading outside of black swan sort of events, but create an income stream for myself that's reliable. And that is adjustable, but most of the time, doesn't need to be adjusted because, as I said, it's like this. Okay, you see how that, let me go back really quickly. So here we are. Let's say that this is 4 months out in time out here. Okay, as time passes, these options decay much more quickly out here. So by the time we're down to 60 days or so, these options that were significantly out of the money, they've already decayed very rapidly. Hmm, that's very interesting. So maybe I don't have to be quite so close to where the equity's trading and so short term and run the risk of black swan kinds of events wiping out too many of my profits too quickly. This is a 3D graph actually for theta decay. And the thing that you notice here, this is calls, call theta versus time, is that when we go further out in time, okay, this is our current stock price here on this axis. This is actually the amount of theta decay. When is theta its most rapid? Well, for the at the money option, it's right here at the end of its life. But for that same strike price further out, it's decaying out here. Notice these are the options that are significantly out of the money. Notice they're decaying much more quickly out here than is that at the money position. We have to go pretty short term if we're at the money to get much theta decay versus what we're able to achieve in these other positions on the option chain. Okay. So how does this affect spread trades? So here's a graph. Let's say that we have an equity that's trading right here, right around 180 to 185. That's going to be sort of the at the money position. Okay. Let's say that this, you could say, well, this is a bull put, for example, put vertical, okay, on this equity. So it's in the at the money position. Here's what its graph for the position, the spread trade position, theta for this credit spread. So if we were to do this at the money out 140 days out in time, 145, right? Notice it's going to decay every day that passes, every day that passes, every day that passes. But when does it really start to take off, right? When it comes to this theta decay? Well, not until about 30 days. That's why we often talk about credit trades in the 30-day window. Take advantage of this. Okay. Well, what if instead I go with a spread that's a little bit out of the money, maybe 10% out of the money, 8 to 10% out of the money. The strike 165, 160. Okay, let's go back to the 145 in time, 145 days. It starts decaying, and notice how it's more rapid. You see the difference, right? It actually peaks out here at about the 30-day window. And then it starts to drop off, meaning that we've already gotten most of the bang for our buck, so to speak, before it even hits the 30-day window. Oh, okay. What if I go even further out of the money here? Strike 145, 140. How does this one function? Well, it's never going to have as much decay because you're not going to get as much credit if you're this far out of the money. But look at how early it peaks out, right? In terms of the rate of theta decay. In other words, if you can get out of the trade when theta has maximized here, and then you reposition back over here and you do it again, and then you do it again. All the while you're staying pretty far away from where the equity is trading, meaning that you get trades that work most of the time, that don't have to be watched quite so carefully, babysat quite so carefully. I'll give you an example. This is a really good example. Let me show you this. This is dollar and cent gain. And then I'm going to tell you my quick story because it's just the perfect example. So the at the money, you're profitable, but notice, when does the bulk of profit come in here for the at the money position? The last week of its life, exactly the time frame when you can get a black swan event and have the trade go very rapidly against you, right? But if we go further out of the money and further out of the money, the thing that you notice is the peak for profitability happens sooner and sooner when we're out in these time frames. It makes for some really interesting opportunities. Now, before I get, unfortunately, we're out of time for our practical application, but one thing that I want to do is I do want to tell you a story. I'm going to go back. Okay. How many of you were trading in August of 2015? Remember August of 2015? Anybody here trading August 2015? Do you remember what happened in August of 2015? I won't forget it anytime soon. Were you trading in August of 2015? Jeremy, you say yes. What happened in August of 2015? In particular, just 4 days is all it took. Yes, we definitely had a volatility spike, didn't we, Gregory? Absolutely. We had a big waterfall event, right? That was the one, Pedro, where we had the 1,000 points to the downside on a Monday morning, right? That was the one. That was the event I'm talking about. So I was on a train from Florence to Rome the Monday morning that the Dow opened up and fell 1,000 points in the first half hour of trading. Okay. I didn't even know, to be honest with you, that that was happening at the time. Now, it might be interesting for you to know that before I did not have my trading computer with me. This was the first vacation I had taken from trading in 4 years. It might be interesting to know that I had these trades, these out of the money wide iron condors on the SPY. Okay. Um, and I did not need to adjust those trades. Those trades went to profitable conclusions because they were December timeframe. They were significantly out of the money and ultimately went to a very profitable conclusion. Okay. And the reason that I share that is some of you want to be really active traders, and then there's others of you that say, it would be nice to have a portion of my portfolio that kind of just, sits in the background. It gets me really good returns, but that can withstand those sorts of events. This version of an iron condor is beautiful for that. In particular, when we start to see volatility, and we will start to see volatility come back into the market where we can get paid for these kinds of trades again, we can get good credits on these kinds of trades again, they are some of my absolute favorites. And I went through that really quickly. Inside the curriculum, obviously, we take a lot more time to explain that. So I do want to get to the special offer that I have for you today. I know I threw an awful lot at you in a very short amount of time, but what I wanted to show you is who we are at Options Animal, why it is that TradeStation invites us to come, and to show you how we teach individuals to be successful. TradeStation does these events because they want for their clients to be profitable. They want you to win in the markets, because if you do, then you continue to trade. You continue to generate trades and commissions. They want your success. And the thing that TradeStation and others like them have found is that our students, our graduates here at Options Animal, are successful because of everything I just showed you and so much more. When you graduate with us, you really understand options. You understand how to spot opportunities. You understand how to position your portfolios while having the ability to understand and mitigate risk in your portfolios. You also have the ability to adjust trades, again, to bring them back to successful conclusions. That's absolutely key to your long-term success. So we have a very special offer. We are calling it the February 15, the first 7 callers today. And by the way, this can be a 2-minute phone conversation if you don't have time to go into lots of particulars. You can certainly lock in the offer and we can discuss later. 30% off any membership that you choose to purchase with us here at Options Animal. Okay. The free consultation, this is so that you can ask questions and we can ask you questions, get to know you, tailor a program to fit you. Now, it just so happens, and this is very, very important, my friends, if you join us before this Friday, you will receive our weekly trades. The ones that I mentioned, they're closing for 90% success in the marketplace. Okay. You will receive those free for your first 15 months. I purchased those trades when I joined as a student so that I could watch my instructors in real time. I could integrate their methods, our Options Animal method, in real time. In addition, when you purchase a 1-year membership, you will receive 3 bonus months. I do not see an offer like this very often. This is a really, really fantastic offer. We have different levels, different sizes of membership, and that's why we encourage you to call for more information. If you're in the continental U.S., 1-888-297-9165. If you happen to be an international presence with me today, 1-801-331-7500. Okay. On behalf of Options Animal, Thank you so much for your time and attention. Richard, I have several different platforms, including, by the way, the platform that we're with today, TradeStation, that I use in my trading for various and assorted reasons. But these guys are great, and that's why we're one of their preferred educational vendors. We believe in what they do, and they believe in what we do as well, and it works for both sides. So, as an instructor here, I look forward to the opportunity to work with you and to get you to your goals. And as a fellow trader, I can tell you that what we teach here at Options Animal absolutely works. So pick up the phone and call. You'll be very glad that you did. Dawn, thank you so much for having us again. It was really my pleasure to be here today. Pedro, good to see you again. And everyone, please have a wonderful rest of your happy Valentine's Day. Okay, take care.